The stock market looks like a level playing field. Millions of people log in daily, buy a stock here, sell another there, hoping to make a profit. It seems simple, right? Buy low, sell high. But what if I told you that the game is stacked against most investors? That while some people are quietly printing money, the average investor is often left wondering why they can't keep up. Welcome to a world where the rules look fair but they're anything but. Welcome to Meta Finance Lab, where you can get more informative videos related to finance. You can subscribe to the channel for timely updates. To understand why the stock market always seems to rise for some, we have to go back in time, way back to the 1600s. Yes, the stock market isn't a modern invention. The first known stock exchange was in Amsterdam, and it all began with the Dutch East India Company. Imagine this, merchants pooling their money to fund ships that sailed across dangerous oceans. They promised a share of profits to anyone who invested. Sounds exciting, right? But here's the catch: the market quickly turned into a place where rumors, insider knowledge, and timing could make someone a fortune overnight, while the unlucky lost everything. Fast forward to the 1800s, and the US stock market started to take shape. Stocks in railroads, factories, and oil companies became the new way to build wealth, but history repeats itself. Early investors with connections, information, or access to deals often made enormous profits. Meanwhile, the average person, relying on newspaper tips or hearsay, would get burned. Doesn't that sound familiar today? Think about it. By the 1920s, the stock market had become a cultural obsession. People believed that everyone could get rich, and they piled into the market with borrowed money. Then came 1929, the Great Crash. Overnight, fortunes vanished. Banks failed, jobs disappeared, and the economy collapsed. Yet, only a select few had hedged their bets, sold short, or had inside knowledge, and they walked away unscathed. But here's the twist: even with rules, those with access to better information, advanced tools, and faster execution still dominated. Think about the rise of big banks, hedge funds, and trading firms. They could analyze trends in real time while the average person waited for a morning newspaper. The rules were changed, but the advantage never disappeared. Now, let's move closer to today. Since the 1980s, technology has transformed trading. Computers replace traders shouting on the floor. Algorithms and high-frequency trading now make money in milliseconds. Imagine two investors: one trades manually, the other uses AI-powered algorithms to detect patterns instantly. Guess who consistently profits? The market is still up, but only certain players are riding the wave. You might be thinking, if the market is rigged, why does it always go up? Well, that's where the illusion comes in. The overall market rises over time, yes, but not evenly. Big players, institutional investors, and insiders can manipulate flow, take advantage of volatility, and use strategies that aren't available to everyday investors. So the stock market going up is T-proof that everyone wins, it S proof that those with the right tools and knowledge almost always do. Let's break this down with an example. Think of a popular stock that doubles in a year. A regular investor buys late after seeing the news, while a hedge fund had already invested months ago, using analytics to predict the movement. By the time the news hits the public, the price skyrockets. The hedge fund sells, locking in massive profits. The individual investor, maybe they catch part of the gain, but often after paying higher prices and taxes. The system rewards speed and insight, not luck. And then there's the hidden world of institutional support. Governments, central banks, and large corporations have a vested interest in keeping markets buoyant. During crashes, they intervene, inject liquidity, or bail out failing giants. That keeps prices from falling too far, creating a safety net for the big players while the average investor sees a temporary dip, sometimes panicking and selling low. Ask yourself, how often does history repeat itself in ways most people don't even notice? Behavioral finance adds another layer. Humans are emotional investors. Fear, greed, and herd mentality drive decisions. Big players know this and exploit it. For example, they release news at strategic times, or rumors circulate that trigger a buying frenzy. Regular investors chase trends, often buying at the top and selling at the bottom. The result: the market seems unfair because, for many, it is. We also have to discuss the magic of compounding and insider advantage. Wealthy investors don't just invest, they leverage. They borrow money at low rates, invest large sums, and reinvest profits. Over time, this creates exponential growth. The average investor, limited by smaller capital and access, can never fully match this growth trajectory. That's why stock market returns are not equally distributed. Think about the 2008 financial crisis. Millions lost homes, jobs, and savings. But major banks and investors, who could buy distressed assets cheaply, emerged wealthier than before. Again, the rules didn't protect everyone equally. The market went up afterward, but the winners were predetermined, those with resources, timing, and inside knowledge. Even today, we see patterns that mirror the past. Look at tech giants Amazon, Apple, Tesla. Early investors and insiders saw astronomical returns. Meanwhile, people joining later had gains, yes, but nowhere near the early insiders. Timing and access matter far more than most realize, and it's all perfectly legal. The system favors those who can analyze, act, and scale faster than the crowd. Now here's a question to consider. If the market is always going up for some, what does that mean for you as an individual investor? It means that passive strategies, like just buying an index fund, can grow wealth over time, but outperforming the market is a different challenge. And that's why education, research, and strategy are critical. Without understanding the rules and the hidden advantages, your returns might feel random or worse, disappointing. Let's look at dividends and insider trading for a second. Dividends provide steady income to some shareholders. Insider trading, though illegal, sometimes gives clues about how insiders anticipate moves. Even legal insider knowledge like quarterly earnings guidance can drastically affect stock prices. The lesson: information and timing are far more powerful than luck. You might think, so what's the solution? Should I just give up? Not at all. The stock market rewards patience, strategy, and awareness. Diversification, understanding risk, and long-term investing are ways the average person can benefit. But here's the twist: even these strategies require knowledge of market mechanics and human behavior. Blindly investing rarely works. Consider index funds. They are marketed as the safe path, and they do grow over time. But the growth trajectory is smoother, slower, and lacks the explosive gains some insiders achieve. You trade potential huge wins for stability. That's a key takeaway: the system has winners, but not everyone can win the same way or at the same pace. History also teaches us about cycles. Markets rise, crash, recover, and repeat. Yet big players use these cycles to their advantage. Crash, buy cheap. Boom, sell high. Small investors often panic at the wrong times, missing opportunities. Awareness of cycles is just helpful, it is essential for anyone who wants to beat average outcomes. Now, let's talk about risk in plain terms. Risk isn't just losing money, it's the chance of missing opportunities. When you sit on cash while others invest, you avoid short-term loss but lose compounding potential. Conversely, taking too much risk without strategy can wipe out capital. The key is balance, something top investors master better than the average person. Behavioral traps are sneaky. Ever bought a stock just because everyone else was? That's herd mentality at work. Or sold during a dip because you panicked? That's fear. Successful investors anticipate these behaviors, positioning themselves to profit while the crowd reacts emotionally. It's almost like they play chess while most play checkers. Another factor is taxes and fees. The average investor often pays more in capital gains, trading fees, and taxes than large institutional players who can optimize or defer them. That eats into returns quietly over years, making it harder to keep up even if performance seems strong on paper. Hidden advantages compound over time, literally. So why does the stock market always go up for some? It's a combination of timing, information, strategy, patience, and scale. Those who understand the system exploit it, while those who don't struggle. But here's the twist: it's not inherently evil. It's a game with rules that reward skill, insight, and preparation. The market itself is neutral, it's the players who determine outcomes. If you take one thing away from all this, remember these 3 points. First, knowledge is power. Learn the rules, cycles, and patterns. Second, patience and strategy matter more than luck. Quick gains are rare and often risky. Third, scale and access amplify returns. That doesn't mean you can't grow wealth, but understanding these truths changes how you approach investing. And here is a final thought to leave you with. The market may seem like it is always going up, but only some players truly ride the wave. Ask yourself, which category do you want to be in? Awareness is the first step toward control. Meta Finance Lab brings you useful knowledge and insights to help you understand the world of finance. Subscribe to stay informed and share with others who need this information.